I think the image a lot of newer real estate investors have is that you need to find this person who just has massive deep pockets and they've got tons of cash sitting there. They're just looking for something to do with it. And in my experience, there are potential private lenders all over the place.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast. Hey guys, welcome to the Legacy Podcast. I am your host, Tim Bratz. Today I'm here with a buddy of mine out of Ohio, Chad Harris. And so Chad, his background has gotten into real estate in 2013, has a portfolio of over 80 doors today, and really specializes on raising private money and educating on raising private money, and has a bunch of different tips and strategies and techniques and really cool things that he does in the capital raising world. And so that's what this episode is going to be a lot about, is raising money. And I'm sure we can go on some other tangents, and I want to hear about your time in Africa, living off grid and all sorts of other stuff, man. So we'll see where the conversation takes us. But dude, welcome, and appreciate you being here.
Hey, thanks, Tim. Glad to be here. Thanks for having me.
Yeah, man. So Chad, let's do this. Let's start out. You're out of Dayton, Ohio. Been in real estate for over a decade now. You have your own rental portfolio. I know you're a big believer in buy and hold type rental real estate, and that's I think we both believe that's the best way to build long-term wealth and maintain long-term wealth. And so I want to dive into all that. But Dayton. Fun fact about Dayton, Ohio. I don't know if you know this, but Procter and Gamble's in Cincinnati, 45 minutes or whatever from you guys, and
Yeah.
Dayton is the perfect cross section of America from a demographic standpoint. And they test all of their products in Dayton before they roll them out anywhere else in the country.
Really? Didn't
Yeah,
know
man.
that.
I went to Miami of Ohio, which is right around the corner from you guys, and
I went to Miami of
learned that
Ohio as
because
well. Didn't know that.
wait, you went to Miami?
Yeah, so did my wife.
Awesome, dude.
Yeah. Yeah.
Awesome,
Small
man.
world.
Yeah, yeah, good stuff. So that's great. Well, let's dive in. Let's go into your backstory, right? In 2013, what got you into real estate, and how you've grown your portfolio, some of the big key takeaways on your journey, lessons learned, and let's start there with a high level overview, and then I'd love to get granular on it.
Sure. Yeah. So, I mean, my introduction to real estate, my parents had rentals when I was young. I did a lot of the maintenance, worked on them, dealt with tenants. I said I never want to have rentals. And they had this legacy plan that someday, their children would take over them. I said, no way. I'm go ahead and sell them all. And at that time, I was moving overseas in ministry, moved to Kenya. I figured I'd live in Kenya, at least for, the career portion of our life. And so they sold their rentals and we went on to ministry and lived over there. Well, we were over there 4 years, came back for the birth of our youngest son. And when he was born, he had health issues and needed a breathing machine and couldn't fly, couldn't live in the remote area that we lived in. And suddenly I had a much different perspective, right? I needed to pay bills. I really felt like that was the point where it kind of hit home that I needed to provide more for my kids. And I'm all about living for impact and leveraging our time to impact others. But I felt like I had kind of let my kids down a little bit financially and needed to make a change. And I knew that real estate could do that. And I just decided I was going into real estate. I really had no way to borrow money, looked terrible on to a bank, didn't know how I could buy real estate, but I was just committed that no matter what, that's what I was going to do. So that was
Love,
2013. There were still a lot of foreclosures. If you could come up with cash, you could get a good deal,
dude.
right?
Yeah.
And so thankfully, I was used to raising money for ministry. So I had raised over $1 million for ministry, didn't have any training for it, just figured it out through trial and error. And so when I started talking to people about what I was doing and telling them, hey, I'm buying real estate, I'm going to buy rentals, over and over, they would respond with, I always wanted to do that. I almost bought a rental a few years ago. I wish I had. And it it hit me that there was this opportunity where I could help them get into real estate, which is what they really wanted. It would just be as a lender in my business, and I could use those skills for raising money for ministry and real estate. And so that's how I got my start.
Love it, man. No, it's super interesting. I think a lot of us have this expectation of handing our business down to our kids, right? I think a lot of entrepreneurs have that built up in their head and they tell themselves this story for 10, 15, 20 years while they're building the business and their kids are growing up. It's like, this is going to be my exit strategy, right? And then the kids get old enough and they're like, no, dad, you weren't around, or that was stressful, or I don't want to deal with that when I'm grown up. And they don't understand maybe the full picture of it at a younger age, and they're like, no, I don't want to deal with that. And then we're like, oh, well, now what do we do with our portfolio, right? And depending on the size of it and what other exit strategies you might have, typically it's the most common one is just sell it all and put the cash in the bank and then disperse the cash to our kids. But it's interesting that you came kind of full circle and you realize, hey, this I've matured a little bit. I see the bigger picture. I understand why my parents did do the rentals, and I understand what it can convey, and the benefits exceed what the downsides are. And that'll be interesting to see if if my kids have any interest in that, or what that looks like. And I've never put it on them. I'm totally very
Yeah.
aware that it might be something that they have zero interest in. My daughter was telling me she wants to be a teacher and or a doctor of some sort when she's older, and might have two careers and all this other stuff. And I was like, listen, you can do whatever you want. If you own a couple rental properties too, right? Like having a handful of rentals, you don't have to worry about Social Security. You don't have to worry about a 401k. You don't have to worry about a retirement plan, because these rentals can be your retirement. They spit off
Right.
cash flow and they have real equity that is sellable, lendable, right? Like there's real value there. So no matter what you do, just have a couple of rentals so that way you have options and to be able to do whatever you want. I think is a really important message to
For
convey to our
sure.
kids.
And the earlier they start, I mean, with rentals over time, everything works in your favor, right?
Mm-hmm.
Values go up, the rents go up, the debt goes down. So the earlier they start, they really don't need very many rentals to drastically change their financial future down the road.
Dude, imagine having a couple of rentals at the age of 20 years old, right? And they double in value over the course of the next 30 years. Then they're also paid off over the next 30 years. If you can
Yeah.
get your hands on 10 rentals, even if it's single family or small multifamily or whatever, get your hands on 10 rentals at 20 years old. By the time you're 50, dude, you're talking about a multi-million dollar portfolio that's spitting off hundreds of thousands of dollars a year in positive cash flow and sitting on a few $1 million in equity. So it doesn't matter what you do for the 30 years in between. You could have any sort of career that you want. You know that your retirement's taken care of. So no, man, I wholeheartedly
Yeah.
agree with you on that outlook.
So yeah, I never pushed real estate on my kids at all, right? I figured they'd want to go do other things. My oldest son graduated recently. He's 19, wants to go into real estate or wanted to go into real estate. So he got a job with a wholesaler and then transitioned into our business, bought his first rental this year, right? Used private money, bought it at a discount, didn't need to use his own money. He's refinancing it now, and he's got almost $60,000 in equity in this rental that's cash flowing. He's 19.
It's amazing.
I didn't have $60,000 when I got started in real estate at 38,
No
right?
chance. Yeah.
So yeah, what a change. So
Yeah, man, that's amazing.
great.
Well, good for you guys, or good for him. It's really, really cool to see. I've been kind of playing with this idea. My oldest is 10 years old. So I'm like,
Okay.
let's go and get you a rental, right? Like and she's all game for it. The issue is she thinks rentals are like Airbnbs, right? And really nice Airbnbs. I have like a really cool mountain house that we Airbnb, but it's like very high end. We have like an island that we do some short term rentals and events at, and a couple of very unique properties. And she thinks that's a rental. I was like, this is not a rental, right? Like she's never seen the C class 70s
Yeah.
vintage apartment buildings in the middle of nowhere, Georgia, that we own also, and or had to walk through any of those. And so it was an eye opener when we started walking through some rehab projects and some other things like that. She's like, this thing needs a wrecking ball, right? Not a paint job. Um, And so anyways, but she's coming around. She like really, really wants a rental. So we're going to come up with something. And I think there's some trusts, like you got to figure out how to even put it, entitle it in her name. You got to put it into a
Mm,
trust. You got to get attorneys involved, have, all this kind of beneficiary type things going on. How can you get a loan on it and all this stuff? So we're going to figure that out. And I'm going to probably do some social media stuff about it, tracking that journey of how my 10-year-old bought her first rental. But dude, I love it. I
sure.
love just like seeing their wheels turn, them learning about it, them being engaged in it and having ownership of it. I think is a different angle than them just having to go work at the property and,
Yeah,
shovel crap and,
100%.
spray
Yeah.
for bugs and do all the disgusting stuff. If they can see the benefits of it outside of just an hourly wage, I think it makes a big, big difference. So it's really cool to see what your
Yeah.
son's doing. Let's talk about how you guys raise money, right? And how you haven't used any banks for your portfolio of 80 doors. I'd assume that's north of a $10 million portfolio, and
Yeah.
um, and you've done it all with private capital. So let's first back up and talk about um, where do you go out and find private money? Like who are you talking to? Where are the conversations? Where are the locations? What are the watering holes that money hangs out at?
Yeah, great question. I mean, really, that's a lot of people's first question, right? How do I find these private lenders? And it's kind
Mm-hmm.
of like I think the image a lot of newer real estate investors have is that you need to find this person who just has massive deep pockets and they've got tons of cash sitting there. They're just looking for something to do with it. And in my experience, there are potential private lenders all over the place.
Mm-hmm.
Um, and so I recommend two ways, right? The way I started was I just told my story everywhere. I told everybody what I was doing and that I was sharing the profits with friends, family, people I knew instead of the bank. That was it. And I made sure that every room I got into, everybody knew what I was doing. So that may seem a little awkward sometimes, like, Chad, what's new? How are you today? I'm doing great. Thanks for asking. I'm buying these distressed houses, renting them to great families, sharing the profits with people I know, right? But over time, when you just give that opportunity for other people to ask, well, how do I share in the profits in your deals? You meet potential lenders all the time. But there are also places that you can directly go and initiate those relationships and be more direct and initiate those conversations as well. Um, And it's just more a matter of having that conversation, not in a method of asking, right? We're never going to ask somebody for money, but from the perspective of we're giving this person an opportunity to be in real estate. They love the idea of real estate, but it's intimidating. And just how do
Mm-hmm.
you structure that conversation so that you can present that opportunity to them?
Well, I found it's more of an educational process than it is a sales process.
Yeah,
Most people don't even realize that they can invest and lend on real
right.
estate to real estate investors. So number one, making them aware of it. Number two is educating how are you secured and why is it better than the traditional way of investing, which is money market accounts, certificates of deposit, and putting money in a bank account or into the stock market, right? Like that's all that people usually do, and this is an alternative that people don't even know is an option. So educating on that and the benefits of that, and then specifically how it's structured and um, the specific deal. So we're going to dive into each one of those. Is there an avatar looking at all your real estate investors, lenders? Is there a specific avatar that majority of them fall into? Are they, what is their career? What is their, socioeconomic status? Like, give me some parameters and variables that people can look for in their own network of like, oh, this person falls into this kind of a category.
Yeah, yeah. There's a few avatars that work really well. So we're looking for somebody who already invests in the stock market, right? They're used to comparing investments. They're at least sophisticated, understand investments, understand the benefits, and they're
Is
upper
there a
middle
way to
class.
quantify that
Right?
person in your mind?
What's that?
can you quantify that person? Like, is that an accredited investor? Like that's where my head goes when you say that. Is somebody who's actually got
So
cash, has money in the account, and they're making,
it it could
six
be they're
figures a year or whatever.
accredited, right? It could be that they're to that level, but not necessarily. It could just be that they have investments, but they're not quite accredited. But they're used to comparing investments. A lot of times they have a financial planner, right, that they get advice from, but they still compare their own investments. They know why to invest in one stock versus a mutual fund versus a CD,
Okay.
right? Number two, a lot of really good private lenders have owned a business either currently or at some time. And
Mm-hmm.
it could be that they're busy in their business now, they're generating cash, but they don't have time to get into real estate. Or they're more of an ender, they've sold the business, they have cash, but they really don't want to be active, right? They're looking for that passive investment. Or a third avatar is somebody who they're working their W-2, they're happy, but they've switched jobs at some point and they have an old 401k with their past employer. They have no idea how much money's in it, what it's doing, right? And when we talk to them about a self-directed IRA and the benefits of that, that's a no-brainer for them to convert that to a self-directed IRA and have an impact on the community, be involved in a business they care about, and get a return. Those are
I
really
love it,
the
man.
three key categories.
I agree with that. And so when I look at mine and I funnel it down to who are the all of my investors, one is accredited investors, right? People who have $1 million net worth or make 200 grand a year or more. They have the disposable income. They have the financial intelligence that you were talking about in your group number one. Um, Another group for me, which probably comprises 80% of all my private money, is your group number two, which is entrepreneurs.
Mm,
Anybody who owns a business, any industry, they think like business owners because they are business owners. They think like investors. They're too busy making money over here and they don't have time to multiply it. So they'd rather give it to one of us to go and multiply it on their behalf. Or they've exited and now they want to just be a lender and be passive, but still kind of be involved in the upside of these things. And that gets them really excited. And then number three for me would be real estate professionals, people who are familiar with real estate. But usually it's pretty hard to raise money from real estate professionals most times because they think they know everything. They're comparing active income and active returns. If I put my 100K into this flip, I can make 200K on it versus 100K into a passive deal. I can only make 12 or 15 grand or whatever on it. And they're comparing apples to oranges. But I raise a lot of money from real estate professionals like right now at the end of the year, the last, let's call it 2-3 months of the year, they have active income and they're looking for depreciation. And so I raise a lot of money from them on the depreciation side toward the end of the year to help offset their active income because they're real estate professionals. They can use passive losses to offset their active income. So that's been a
sure.
big one towards the tail end of the year. We always raise $5 to $10 million a year in November, December from that cohort. But I think a big one that you mentioned that goes way overlooked is your category number three, which is the self-directed or potential to having self-directed retirement accounts. This is a tranche of money that is just sitting there and nobody knows what to do with it, how it's performing to your point, and that they can even very easily have it converted inside of a couple of weeks to a self-directed account and make better returns, more predictable returns, and some excitement in it, right? By
Yeah.
investing it into that. And it's hugely beneficial for us as borrowers because one, it's patient money, right? It doesn't need to be paid back in 12 months or 36 months or even
Yeah, they
60
can't
months,
touch
right? It
it
can,
anyway. Yeah.
yeah, I mean, they want to keep on rolling it and rolling it because they're not even thinking about touching it until they're 59 and a half years old. And so it gives plenty of runway for the operator to then be able to go and have patient money. And typically they're not looking for these insane returns either, right? They're not looking for the 25% big hits and
No, yeah.
like they just want predictable. Hey, pay me 6 to 12%
Yep.
predictably every year without the volatility of the stock market. I have my new 401k in that. I'd love to deploy this into something more predictable. And so it kind of gives them the opportunity to balance out their retirement portfolio by having both real estate and stocks that way. So I love that.
Yeah.
As you're having those conversations, are you looking like who are this? It just happens in normal conversation. You just bring it up. Hey, do you have a 401k? Do you have a from an old job? Like how does that conversation? How do you bring that up?
Yeah. Yeah. So usually it's once we meet, right? I'm always building new relationships, adding to my network. Hey, can I buy you coffee, explain to you what my business does, how we include share the profits with other people, right? Real easy conversation. And then in that conversation, you want to build rapport and get to
Yeah.
know the other person. And so you just naturally ask about their family life, what they do for fun, and what types of investments they have, whether they have an old 401k, all of those questions of just getting to know them so that we know how to present the opportunity to them to best fit what they're looking for, right?
Mm-hmm.
I believe that service is the key to business. The more people we serve, the bigger our business grows. So in that conversation, I'm just looking for any opportunity for our business to serve them, really.
This episode of the Legacy Podcast is brought to you by Legacy Family Mastermind. I know what you're going through. I know you feel stuck in small deals, trying to figure out how do you get to that next level. I know it's hard to raise private money for real estate deals the way that the economy's been over the past few years. There are probably properties in your portfolio right now that are either losing money or at best break even, and you're trying to figure out how to turn them into winners. Or you're thinking to yourself, dude, I just want to be able to go on vacation without my business all being on my shoulders. Not having the time freedom or the financial freedom that you thought real estate was going to give you, I see it over and over and over again. But I've got the solution to every single one of those. Legacy Family Mastermind. This is a group of high-level commercial real estate investors that can help you break through every single one of those bottlenecks and help you get to that next level. I mean, you know the saying that when the student is ready, the teacher appears. Here we are. If you are serious about scaling your rental portfolio, we are here for you. This is the group to do it with. We would love to help you on that journey and design the exact life that you want to design so that way you can live it to the fullest. The next step is simple. Just schedule a call with my team at the link below and we'll see if it's a fit, because I want to see you sitting at the table with our Legacy family. Let's go build some wealth together. And that's been a recurring theme in the way that you've delivered over the course of this podcast is like, you're always leading with value. You're always figuring out how you can make an impact both to the lender, but also to the community, for the tenants, right? And you're leading with this value. And if you help
Yeah.
enough other people get what they want, man, guess what? You're always taken care of too. And it's a
Yeah.
big Zig Ziglar quote that we live by of lead with value. And it will come full circle. It doesn't just, you don't just reap what you sow, you reap many times more than what you sow. So in self-interest, go and sow the best seeds and be the best person and deliver as much value as you possibly can, because it will come full circle many times over, the value that you give. And so that's a huge core, I can tell, in how you guys operate, and it's why we connect
Yeah.
so well, because we run the
Yeah.
same way. From the way that you raise money, because you raise money from a single investor onto a single deal, right? So
Correct.
you raise money, you give a mortgage, you give a promissory note, and you insure that, or they're listed as additional insured on the insurance. Is that the three big ones on how
Correct.
they're
Yep.
secured?
Yeah.
And then how do you, um, and so that makes it clean, right? It makes it $100,000 check to this. You don't have to deal with like syndication documents. You don't have to deal with SEC attorneys. As long as there's an actual security in place, which is a mortgage on the property, then you don't have to worry about any of that kind of stuff. So um,
Yeah.
it's a very smart way of going about it, a very clean way of going about it. From a standpoint of deal structure, how do you structure the compensation to your investors? Do you pay a fixed flat fee of interest rate? Do you do some sort of a lower fixed fee and then some equity share? Is it all equity profit share? Like, how do you guys do it?
Yeah, perfect. So the phrase we use all the time is just like the bank, right? Our lenders get the security just like a bank, they get a return just like a bank. And so it's just fixed interest, similar to a dividend, really. So yeah, so we pay anywhere from 6% to 8%. And I structure the deal. So we always say just like the bank, because the security is the security a bank gets and the interest is the earning a bank gets. But we structure the payments a little bit different to fit what they're looking for. So what I learned over the years of dealing with different lenders was they didn't like, at least my ideal lender didn't like going in and out of deals, right? They just want to place their money and forget about it
Mm-hmm.
and just get that return. And so over time, we transitioned to low interest, which equals low risk for them, right? And interest only payments for 10 years. And so they can just get those payments continually. So that's good for us. If the property is cash flowing, we'll just leave it in place. If we want to refinance, then we transfer that mortgage onto another property. And then our
That's
lenders
great.
are
So,
happy.
but you're
Yeah,
paying interest regardless of the deployment of that money. So if that
correct.
property gets refinanced and the cash comes back to you guys, you're still making a payment to your investor because that's what they expect, and that's what the agreement was until you redeploy it, and then you give them another mortgage on the next property, whatever that looks like, and they're okay with that transition period. And um,
Correct.
yeah,
Usually we already have another property, right? I mean, at
I
least
mean
for my
that's a
portfolio
secret, right? You got to stay
personally.
busy, man. You got like the momentum. What I found is more important than finding the perfect property, right? And like just keeping the momentum going then starts bringing better and better deals. And
Yeah,
no, having
yeah,
somebody that's got, that's doing 10, 12, 15 deals a year is a lot better than somebody doing one or two deals, because from a lender standpoint, there's no predictability in that. There's no knowing that, oh, well, now my money's going to sit without generating any interest for another 12 months. Like now I'm getting half the return that I thought I
right.
was going to get
Yeah.
versus having it deployed and predictably making money all the time.
Yeah, when they actually, when you explain to them the comparison of their return, if it's just placed for that full year at 6% versus 10% a portion of the year, their return's the same, right? But that predictability and consistency, knowing that they have that
Mm-hmm.
return ongoing until they decide for something else, to a lot of investors, that's really appealing,
I
right?
love
They
it.
what they don't like is the unpredictability or the unknown of what's going to happen 6 months, a year from now. So,
Hey, what do you say to people who want equity in the deal? Hey, can I get some? But you've set the good expectation of like, hey, you're the bank, right? I'm paying you like the bank. You have none of the risk, right? But I
right,
also get all the upside, right? Because I'm taking the upside and the downside. You have the predictability. You get paid whether I make money or whether I lose money on this. If
right.
somebody wants equity, do you guys are you guys open to that conversation of saying, hey, I just want a 50-50 split. Don't pay me a fixed return.
I don't. In my earlier years, where I, was working harder for lenders, we did some. But in all honesty, my number one priority in investing at this point in building a business is freedom. And I don't really like partners at this
Mm-hmm.
stage, right? I like to do what I want with my business to support my life. And when my lenders are just interest, no equity, that works out better for them. They're not interested in whether the property's occupied or unoccupied or right. They don't really care. They're getting their interest payment, and that
Mm-hmm.
just works out better for me.
No, I agree. I think it keeps it very clean across the board. It's very
Yeah,
clear expectations. Um,
it's a very simple,
dude,
clean
dude, I've had
process.
people come to
Yeah,
me and they say, dude, I want 50-50. Don't pay me like a fixed return. I want 50% of the upside in this thing. And then guess what? We broke even on it. And then they're pissed, even though
yeah,
they came to me saying they want 50%. And then I have to, and actually I'm thinking about a 44 unit building that we flipped early on in my career. I thought I'd flip it in 6 months and make $300,000 on it. And my investor brought 250K, and I was going to pay him a fixed 10%, right?
hmm
For 6 months. And he goes, no, I want 50-50. So I said, listen, all right, but you got the up. And we walked in and we realized, although it was 80% physically occupied, it was only 25% economically occupied. And some of the due diligence and that kind of stuff was not 100% above board. And we found out we were walking into a situation where we had to evict, right? Not only were we not collecting the income, but now we had to kick out a bunch of tenants. Then we had to renovate three times as many units as we thought we were originally going to have to renovate and go through the lease up process. And it was over like the end of the year. So like the holidays were a delay then too, and like all this stuff. So it ended up being a deal that we lost 50 grand on it. He was responsible for writing a check for $25,000 of it. And so was I. And not only that, but he didn't make the return. Right. And so
Yeah.
what do you do? So even though he wanted that, he's a big boy, he's got a traditional business, and he came to me. I still ate it. I wrote the entire $50,000 check, and then I had to give him, not I had to, but I willingly gave him equity in another deal to make up for it because he did trust me in the operational
Mm.
side of things. But it just, I always go back to that and thinking people think they want one thing, right? Some of these lenders think they want one thing, but the reality is like we know better because we've seen stories like that play out where uh,
Yeah.
it's like going gambling. Like people, they only talk about their wins. They don't ever talk about their losses, right? These degenerate gamblers, they our brain suppresses loss and it only thinks about the upside,
Celebrates the
and so
win.
it
Yeah.
discounts the downside of things, and that's unfortunately what a lot of these investors
Yeah.
sometimes look for. So
For sure.
it's interesting. I do like one thing that I've done before is I've gotten a lower rate of return, and I'll say, hey, listen, I'll pay you 10% fixed return or 8% fixed return annually on your money, or 15% of the profits, whichever's more. So now it gives them like
Hmm.
a baseline worst case scenario, but also they feel like they're involved and they feel like they have the excitement of the upside. And it's easier to raise money that way. And at the same time, they have zero decision making still, right? And so there's a lot of ways,
That's
for
sharp.
anybody who's listening, there's a lot of
Yeah.
ways to structure this stuff. There's a lot of ways to get creative with it and really figuring out what Chad does great is like you sit down and you fact find of what do they need? Are they looking for predictable cash flow? Are they looking for equity upside? Are they looking for, they have 401k? Do they have cash? If they have investing with cash, they probably need to offset that in some capacity, maybe with some depreciation on the returns that they're getting. And so like there's a lot of different ways that you can kind of structure things to make it make sense for your investors and utilizing these different tools in the tool belt, right? But it's all through education. I think that's a big part of it that we discount.
I mean, even just right there, you saying they want a fixed return. They don't want a loss, but they want the excitement of a potential upside.
Mm-hmm.
And so you come up with a creative solution, a creative way to structure it so they get what they want, right?
Mm-hmm.
You can raise all the money in the world if you're offering exactly what your potential lender wants, right?
Yep.
That's huge. I love that.
Dude, I love the yeah. I think a lot of life is about expectations, right? We just went to Europe with the kids, and I've been to Europe many, many times. I used to travel there, live there overseas for a little bit, and then actually Luxembourg at the
Hmm.
Miami campus that's over there.
Okay. Yeah.
Studied abroad, and then would go back once or twice a year for I don't know 15 years afterwards until COVID hit. So, anyways, we're taking the kids back, and I set this really low bar. I was like, it's different. The toilets are different. They don't have air conditioning all over the place. We travel through train stations. There's different smells, different kinds of foods, different kinds of like sights, and all these things that you're going to see. And I set like this low bar, this low expectation. And guess what? If you set it at a 1 out of 10 or 2 out of 10, and it ends up being a 3 out of 10, dude, it beats the X, and everybody's happy, right? But if you set
Yeah.
it like we're going to Europe, it's going to be the best time ever, it's going to be the best vacation you've ever taken, and you set it at a 9 out of 10, and it's an 8 out of 10, dude, everybody's disappointed, and I think that's a big thing with a lot of life in setting up business partnerships, setting up private lender expectations, and raising the private money and what to expect on their money. And if you set it at a 6% return, that's a good, predictable, but yet very, I mean, it's 50% more than what money markets are paying, right?
Right.
Um,
Yeah.
and it's not 2% more, it's 50% more than what they would make in a money market account right now.
And
And
if
that's if
you,
they have a minimum deposit of probably 100 or $200,000 in there. So, um,
yeah.
it's a better return. And at the same time, you can kick them an extra half a point or an extra point, and now it just like really blows it out of the water, even if you're not doing profit share or anything like that. And then they get super excited, right? And so you set this expectation,
Right.
you exceed that expectation, man, and everybody's super happy. So
Well, I love that point. Yeah, and what I like is that when you're talking to a private lender, usually it's the financial planner setting the expectation, right? They're the ones saying, "Oh, you can expect 4% in retirement, you can expect
Mm-hmm.
3%, whatever." So when you come in and say, "I can pay 6% or 8%," I mean, you're 50% or 100% more, and if they're basing their lifestyle off this expectation that the financial planner has given them, and you can double their lifestyle. You can double the vacations they can take their grandkids on. You can double the experiences they have. I mean,
Dude,
that
that's a
is huge,
great,
right?
it's a great
Yeah.
point. I had this conversation 2 weeks ago with a buddy of mine who's an investment banker, right? And he's one of my best friends from high school and college, and has been done very, very well. And he's like, "Listen, man, I've had lifestyle creep, and I need to make 50 grand a month. I need to be at $600,000 a year in order to make sure my lifestyle is covered. And in order for me to do that, I need about 12 to 15 million dollars liquid by the time I'm 60 years old, and I want to retire, by the time I'm 60, right?" And I was like, "Dude, 12 million bucks, that's a 5% return on 12 million dollars in order to feed your lifestyle, right?" And
Yeah.
I was like, "What if you got 10%? Then you need half the amount of money because you're making
Yeah.
double the return." To your point,
Yeah.
is now you can retire in 10 years instead of 20 years, or retire in 7 years instead of 20 years, because you're making 10% on your money. Like, that's a big difference. And people just don't maybe conceptualize that, because the expectation that they've set or been set through traditional advisors is like this low, low bar that they're going to have to work until they're essentially 65, 70 years old in order to save up this amount of money to get this little dumpy return. Whereas if you pull some different levers here, like, you can hit that way sooner and have the lifestyle that you're looking for way sooner. And again, it's our
Yeah.
job to educate on that, right? It's our
Right.
job to sit down with them and let them know, hey, what if you did this instead of that? And it's a total game changer.
Yeah. That's amazing. And if you have examples of lenders you've already provided that for and say, here's the benefit, this lender got from this deal, they can immediately see how it impacts their life. It's not really you even telling them or educating them. You're just showing a demonstration of how great this other lender's life was. It's very, I feel like it's very empowering because
I agree.
you're opening their mind to a totally different opportunity or way of life, double returns and retiring in half the time and
You're
all of
kind of
those
acting like a
things.
financial advisor, right? Just
Right.
not somebody who gets paid.
Yeah.
What I like about it is you're on the same side of the table, right? And actually,
Yeah.
financial advisor in a 401k, or I'm sorry, in the stock market, they get paid whether your portfolio goes up in value or down in value. They still get paid. Maybe they don't get paid as much, right? But they're getting paid based on the total amount of assets under management. You and I, when we borrow someone's money for a cash flowing deal, they're getting paid no matter what happens to the value of that asset, right? If it goes
Yep.
up or it goes down,
Yep.
they're still making the same amount of money. So it's it's completely flipped on its head of the way that we are in the same boat, rowing in the same direction with our investors. We want this to perform as well as possible, and are going to be actively involved in making sure it performs as well as possible, because uh, we can, one, pay their return, and two, we make more money after we don't get paid until after they get paid, right? A
Right.
financial
Yeah.
advisor gets paid whether or not we
On
get
the
paid,
front.
right? They're getting
Yeah.
paid first. So it's very
Yeah.
different from an advisory standpoint. And I think it's important that they understand that, listen, you get paid first, I get paid second, right? I'm prioritizing your returns over any sort of profits in my world. And again, it's a flip of the script in what they're used to. And so sometimes, I mean, most people don't even realize that that's how these brokers and these financial advisors get paid, and it's important for them to
Sure.
understand that this is the case. So
Yeah.
no, it's great, man. So let me ask you this, as we're kind of winding down here: if you're talking to somebody and and they want to go out and raise $1 million, and they need to raise it between now and the end of the year, um, say 60, 90 days out, what would be the advice that you would give them to reach this big goal in a short amount of time frame? Like, what are the most needle moving actions that somebody can take to see a lot of momentum and build up a lot of momentum right out of the gate and achieve that goal?
Yeah. I mean, always, if you have big goals, massive imperfect action, right? I would start talking to as many people as possible and be the great networker, put a lot of effort into that. And I would leverage social media. I mean, you can't ask for money in social media, but you can. Social media is amazing for just leveraging your time in getting a message out, right? And if you want people to know you are active in real estate and you share the profits with people you know, done, right? One post, a post a week, whatever, a post a day, everybody in your network will at least know what you're doing. And then when you make that phone call, hey, would you like to get coffee? Do you want to have a conversation about what my business does, how you could share in the profits? It's not really a cold call. They know you, and now from social media, they know what you're doing. And so I would just do massive imperfect action on both fronts with that and have a lot of conversations. Because the reality is there are a lot of people out there that are really desiring what we have to offer. We just need to have more of those conversations, right?
Mm-hmm.
More of that education piece on so that they know the opportunity they have with us. That's it.
I love it, man. I love the one to many approach, right? Posting one time on social media and 30 people see it, right? Like that's 30 conversations and cups of coffee and probably 30 hours minimum of time that you're
Right.
saving by putting out one post as opposed to going and meeting with people for coffee 30 times and having obligatory conversations and small talk. And I know we want to build rapport and develop relationships and all that kind of stuff, but just the timeline in everybody's brain is if we're going to go meet for coffee, I better block out an hour to meet for coffee. Whereas let me type up a quick post on social media, push it out one time. It takes you 15 minutes and it goes out. 30 people see it and raise their hand saying, I'm interested in what you got going on. Right. And it's,
Yeah.
I love that
Just,
one to many
yeah.
approach. I love the social media aspect from a educational approach too, right? We can start educating and building confidence and credibility in what we do by educating on social media and talking and having these conversations. So it's not just oh, Chad, I had no idea that you raised money. Like, obviously, man, we're friends on Facebook. I've seen what you're doing, man. Really cool. Tell me more about that deal over on Oak Street that you just flipped with the bed bugs and all the crazy stuff that you had to deal with, man. That must have been nuts. And you're like, yeah, well, hey, I bought it at this price. I made it worth this amount. I paid my investor this percentage. Dude, they were happy. I'm happy.
Right.
It's now a great property in the portfolio. Boom, boom, boom. Oh my
They got
gosh,
their
how do I become the
return.
lender? Right. And it's a
Yeah.
natural, organic
Yeah.
conversation, all because you posted about bed bugs on social media and the stuff that you dealt with, and your lender didn't have to deal with it. Right. Like that's the
Yeah.
exciting stuff
Yeah.
that you can make it very appealing for the lender. So no, man, I
Yeah.
agree. I think make the list, right? Going back to the beginning of this episode, you and I had both put out here's the A players, right? Here's the core avatars of people, and
Hmm.
make a list. Go through your phone book, go through your social media contacts, go through your email contacts, and then reach out to all those people massively, right? Ping them with text messages, ping them with emails, make a phone call, like whatever that looks like. Get in front of them and at least plant those seeds on here's what I got going on. I got some deals closing in the next 90 days, still going through due diligence and looking for some money partners. If you're of any interest in
Yeah.
passively working with us, would love to just, hop on a quick phone call with you, dude. And I think
And
it's
yeah.
just that many, many times over. And if there's ways to do the multiplier effect through social media, through an email blast, or through any other medium, and I think that's a great piece of advice that you gave.
And I'd encourage everybody listening. A lot of people have that fear of making the phone call. Like this potential lender thinks I'm calling asking for something, right? And that they're nervous about initiating that phone call. But over and over again, myself, clients see the same thing that people welcome that call, right? In our
Mm-hmm.
culture today, people are craving connection. And when you call just to say hi and say, hey, I've got this thing going on with my business, I thought of you, thought you might be interested in hearing about it. They love that, right? You thought of them. So it really is. I mean, that alone, the phone call alone is a blessing to the person you're calling. So don't hesitate in reaching out. They
So
want you to call.
dude, it's a great point, right? We make up these stories in our head about, oh, well, uh, somebody's calling to borrow money, right? That means I'm never going to see it again. And they're probably thinking the same thing about me. And the reality is, No, you're going in with a different approach. You're going in with a value-driven approach that, guess what? They're getting a
Yeah.
crappy return on their investment right now. And you can offer them 50 to 100% more of a return on their investment, helping them get to retirement in half the amount of time. Like, we have a duty, right, to go out
Yeah.
and help people find a better way and provide them with a better way, provide them with the knowledge on how they can achieve their financial goals that much better. And it's selfish if we don't, right? And the other thing that I found is the bad guys are going to do it, whether we do it or not. And so
Mm.
I feel a responsibility. I know that these people are going to invest their money with somebody, and I want to make sure it's invested with me because I'm going to do the right thing with their money versus
Yeah.
some of the bad guys out there who don't care about them the way that I care about them, or don't have the uh, ability to make them whole the way that I would be if a deal goes sideways. Like, it's just that to me gives me a sense of obligation to go out and make sure that I help people before some bad guy goes and rips them off. Because I've heard these stories
That's a
nonstop, man,
good
especially
point.
over the past 5 years of people getting ripped off by bad operators or people who didn't have good intentions or good, core values. And I'm like, right, it's partially my fault because I didn't make them aware that they could invest with me sooner, right, and have a more protected, more secure, better investment plan. So, no, that's
Mm.
fantastic, dude.
That's
So,
powerful.
Jed, let's a lot of great value. You do a lot of, I think you do some coaching on raising money and stuff too, don't you?
Yeah, I do. I coach people on how to raise money, fund their deals with other people's money.
Where's the best place where people can connect with you, learn a little bit more about what you guys have going on, follow you on social media? Like, what's the best place for them to connect with you?
Yeah, probably the easiest way is to go to our website, truewealthinvestors.com. It's got all the links to social media, podcast, YouTube, all of that. Real simple there. If people are interested in finding private lenders, if anybody's kind of struggling with that, how do I know who to talk to? We have a resource, 37 places to find private lenders. And if you're looking to raise money at the end of the year, right, you got that push, you have the deal ready, that's a good way to narrow down your search and actually push you on who to put on that list first to contact. And you can get that at truewealthinvestors.com/find lenders.
Love it, man. That's awesome. We'll link to all that stuff in the show notes. Make sure that you're tagged in all the social media stuff, and so that way people it makes it super easy for people to connect with you. So that's awesome, man. Well, hey, I appreciate you being here, dude. It's great to have a fellow Red Hawk. And um,
Yeah,
were you a Redskin when you were there?
I was there right at the
I was
transition.
gonna say that.
Started as a Redskin, yeah,
Yeah,
left as a Red Hawk. So
yeah, and fellow Ohio guy. So that's awesome, man. Well, congratulations on your success. I love what you're doing. I love that you're leading with value. And I think raising private money is the most important technical skill that any of us can learn in any industry, right? You will always have value regardless of the asset class, regardless of the industry, regardless of the economy, regardless of what's going on with the market and which way the wind's blowing, if you know how to raise money. Like, if this is a skill set that all of us need to know how to do, because it is the most versatile and most important skill set in business. So, good stuff, man. I love it. Well, I appreciate you being here. And until next time, we'll see you guys on the Legacy Podcast.
thanks, Tim.